Yesterday, President Biden signed into law the $1.9 trillion stimulus package, which has enough juice in it to send GDP soaring over 10% this year. Meanwhile, the federal budget deficit is already big enough to swallow up some countries' entire GDP. The world still loves buying our debt. Inflation is nowhere to be seen, and hundreds of thousands of people are still getting laid off each week. I think economists are going to have to start rewriting some of those Econ 101 textbooks in 2021. All that and more in this week's Friday Econ Update. Let's get into it. The much-anticipated $1.9 trillion stimulus package was signed by President Biden yesterday, and it could pack quite a punch to our economy. Based on the latest data from the Bureau of Economic Analysis, GDP is down by about $260 billion as of the fourth quarter of 2020. If we assume that all of the $1.9 trillion in spending went entirely into GDP, we would see 2021 GDP increase by 11.7% over 2020 average annual GDP. Now, not all of that $1.9 trillion is going to get picked up in the government's GDP calculation. After all, last year GDP dropped by $2.2 trillion from the peak in the fourth quarter of 2019 to the second quarter of 2020. Yet the government passed about $3 trillion stimulus last year. Isn't it annoying when you lose $1 trillion? Where did it go? Well, I seem to be hearing some things lately about stocks, Bitcoin, and real estate hitting record highs this last year. That might be where some people are squirreling away some of that stimulus money. And these days, you can't have a good stimulus package without a good deficit. On Wednesday, the U.S. Treasury Department reported that the government's deficit was already at $1.05 trillion through the first 5 months of their fiscal year. And this was a 68% increase over the $624.5 billion from the same time period the prior fiscal year. This comes after the Congressional Budget Office estimated in February that the government would hit a $2.3 trillion deficit in 2021, and that doesn't even count the $1.9 trillion stimulus signed into law yesterday. So, we're passing stimulus packages that are the economic equivalent of performance-enhancing drugs, and you would think that we'd get caught by the inflation referee, right? Well, not exactly. The Bureau of Labor Statistics released the February Consumer Price Index on Wednesday, which showed that consumer prices increased by 1.7% year over year, which was a bit higher than the previous month, but nowhere near any kind of danger level compared to historic levels when you take a long time frame into perspective. In fact, bond investors don't seem to be very concerned either. This Wednesday, a typically routine Treasury auction for $38 billion had a lot more eyes on it than these auctions usually get. With bond yields trending higher the last few months, some have been worried that this signals inflation is on the way. But things went smoothly, with demand being considered adequate enough to alleviate these fears. With all this confidence in the US dollar, you would think our economy's on pretty solid ground, right? We did have a pickup in employment growth in the latest jobs report, putting us back on a trend in the right direction after several months of subpar numbers. However, weekly jobless claims remain stubbornly high, with the latest figures released on Thursday showing almost 750,000 people filed for unemployment insurance last week, which is significantly higher than the pre-pandemic weekly average of around 200,000. So, what's the real answer here? Why is inflation so low even though we are clearly spending more than we have and printing a large portion of it to support our economy? In my opinion, it's that no one really cares. Wall Street knows what's going on, and other countries know what's going on too. This isn't a secret. Despite the deficit the government is already running in 2021, They know that the Federal Reserve will print every dollar needed to fund this stimulus that isn't borrowed from others in Treasury auctions. But the question is, where else are they going to go for yield? What investment is a better safe haven for cash than U.S. Treasuries? The U.S. dollar is backed by nothing but faith in the U.S. dollar, and it looks like there's still a lot of faith in it out there. And as long as that remains the case and there isn't a better alternative, we're unlikely to see significant inflation in the near term. But if that changes, because of the bloated money supply we have right now, inflation could take off real fast if something better comes along. I hope that you've enjoyed our first Friday Econ update episode. Since we're a young channel, we like to play around with different formats to see what people like. If you would like to see more episodes in this format, please comment down below so we can plan on doing more of these. And if you didn't like it, please let me know that as well. It would be counterproductive to our growth if we lose all of our subscribers. Thank you so much for watching, and I'll see you in the next video.